Our next topic is futures and options. This is again related to GS paper 3 capital market, and this has appeared in today's The Indian Express page number 12. So futures and options are kind of derivatives which are deriving its value from some underlying asset. So derivative is a financial contract whose value is deriving from an underlying asset. For example, generally people say कि I get happiness by seeing you smiling. So the happiness of the person is getting derived from the smile of other person. So this happiness is a kind of derivative which is deriving its value from the smile of other person. Okay? And these derivatives is based on the expected future price of that asset, that what can be the future price, whether it will increase or decrease. It does not usually involve ownership of the underlying assets because it is just deriving its value. It is not owning that particular asset. The underlying assets under this can be the shares of the company, stock indices such as Nifty 50, commodities such as gold and crude oil, currencies such as US dollar or Indian rupees, interest rates and bonds. All that can be the underlying assets whose value will be derived based on these derivatives. The purpose of this derivative is to do hedging to reduce the price risk that they are speculating. Price discovery through the future price expectation that whether there will be demand or more supply of that particular asset. Speculation to earn profit from the price movements. There are some of the sophisticated investors who do have the experience in this kind of trading, so they earn profit also. Arbitrage to move the price difference across market. Arbitrage means that if there is a discrepancy in two different markets with regard to the prices, so I can take that benefit. For example, I can buy in NSE and I can sell in BSE if there is a price difference in both the markets. So whatever the difference that will be there, that will be my profit. There are two major types, futures and options. Futures contract, that is the legally binding agreement to buy or sell an asset at a fixed price on a future date. Both buyers and sellers are obligated to execute the contract. Then you have the major features of future contracts is that it is standardized and exchange traded. It requires margin deposit, also daily settlement through mark to market. There can be two positions, either it can be the long and short. The risk and returns associated with this is that gains and losses are unlimited and profit and loss are realized daily. And then options contract, a contract giving the buyer right but not the obligation to buy or sell an asset at a specified price. Only the seller is obligated if the buyer exercises the option. Okay. The types of this options contract is the call option that gives right to buy, put option that gives right to sell. The major features of this options contract is that the buyer pays a premium and then buyer has the limited risk. Seller earns premium but bears the higher risk. The risk and return associated with this is that buyer's maximum loss is limited to premium. The seller may face large or unlimited losses. In India, they all are regulated by the Security and Exchange Board of India, which is the regulator of Indian capital market. Also, this is traded mainly on National Stock Exchange and Bombay Stock Exchange, which are the exchanges in India.